So wherever you've held your money this year, you've pretty much lost out. Held in cash, you've lost 7% to inflation. Held in UK government bonds, you've lost 12.7%. Held in an S&P 500 ETF, you've lost 14%. And even if you managed to venture into cryptocurrency and invested into the likes of Bitcoin, you'd be down 22%. Apart from really the property market, asset classes are sinking faster than the Titanic.
I'll never let go.
And with Bank of England interest rates now up at 1%, with threats of 10% inflation by the end of the year, how exactly can you beat this upcoming market recession?
I don't know.
Well, whilst it might feel like a bit of an environment where you're just looking to not lose as much money, there are still some good investment opportunities out there when you apply some context to them. But I think what most investors are worrying about right now is this upcoming recession being one of the drivers behind a good old-fashioned stock market crash. So with the recession on the cards, will all of this get worse before it gets better? Well, let's talk about it, and then towards the end of the video I'll discuss in a little bit more detail the investment options which you have in order to weather this storm. So it's of course no secret that a recession is certainly on the cards in 2022, and in actual fact some economists are stating that there is a 35% chance of recession this year. But let's be honest, it pretty much feels like a downright certainty. The cost of living is going up, inflation is running rampant, interest rates are going up, the supply chain and cost pressures on businesses, and the macroeconomic environment is nothing short of a meltdown waiting to happen. However, with all of these things going on, both interest rates and inflation are two of the key economic drivers that you're certainly going to want to pay close attention to, because when interest rates are low and inflation is running smoothly, you'll find yourself in a booming economy. But when interest rates and inflation are both high, then you're probably going to end up in a recession, and that's where you see 2 consecutive quarters of negative GDP growth. Hashtag economics 101. So assuming we are actually heading for a recession, what does that exactly mean for the stock market? Because the economy and the stock market are 2 different things. Immediately when you think about a recession, you probably have flashbacks to the 2008 financial crisis, where both the stock market and the property market imploded.
And it's gone. Poof.
Or if you're under the age of 30, perhaps you don't have flashbacks because you were probably kicking a ball somewhere around in a park. However, we've all seen the charts of how the stock market crashed 55%. So are we heading for a 2008 style market crash, or is this not going to be quite as bad as we think? Well, let's take a look at some data to see how all of this may play out. So generally speaking, recessions and the stock market do typically go hand in hand. If you look at some of the major recessions over the course of the past 100 years, when GDP fell, the stock market fell as well. However, there is probably quite a loose correlation between GDP growth rates as well as the size of the stock market decline, because it does certainly fluctuate on a case-by-case basis. For example, when all hell broke loose back in the dot-com bubble back in the early 2000s, GDP dropped 0.3%. However, the stock market tanked 49.1%, whereas in the post-World War II recession, GDP declined 12.7%, whereas the stock market only declined 10.1%. So there is certainly a little bit of a mismatch between the conditions in the economy versus the conditions in the stock market, and as a result, they're not always perfectly correlated. So that kind of gets me thinking, well, what position are we in right now? Well, first let's address the state of the stock market. Valuations are at historical premiums, especially when you look at the US stock market. They weren't quite as high as the dot-com bubble, but they weren't exactly a million miles off its peak. So that is certainly one of the main factors to consider, the fact that stock market prices are trading at a premium. And when we saw that back in the dot-com bubble, well, as I've already said, stock market prices created about 50%. But then we have the current state of the economy, where we currently have inflation running hot and central bankers are using the interest rates in order to curb the levels of inflation. When we relate this back to the dot-com bubble, well, inflation at the time was roughly about 4%, so it was a little bit high but certainly nothing crazy. However, at the time, interest rates were actually up at 6%, so we pretty much had almost the reverse of what we're seeing right now. Whilst back in the day, economic drivers could be used to actually calm down a recession in the early 2000s, whereas today we don't have the same mechanisms to draw upon, simply because interest rates were already really low before all of this played out. So because of this, we might quite literally have double trouble on our hands when we combine the impacts in the economy and the impacts in the stock market too. And as a result, all of this could be a lot more severe than we think.
Oh, hell no!
Some analysts have spoken about declines between 50 to 70% in the stock market being a strong possibility, But then again, we all love a clickbait title every now and again. Regardless of what your view is on how big the potential stock market crash could be, I think the reality is there is going to be a stock market crash. It's just a little bit of an unknown on how big of a crash that might be. The average bear market is roughly about 35%. So I think it's likely, based on historical averages, that we can assume that a 35% crash is probably something that we should have within our own expectations. After all, we always talk about the average rates of upside for the S&P 500 being 9 to 10% per year, so it probably only feels right to use the historical averages as a benchmark of what could also be the downside too. And with the S&P 500 already down 14% or so, we're not even halfway there yet. So things could certainly get a hell of a lot worse. But let's just briefly speak about market timing. It's a bit of a contentious topic and one that I usually try to steer away from. But in this instance, market timing and understanding market cycles is important, especially when we're talking about the relationship between the economy and the stock market. In economics, we have something called leading and lagging indicators when we're talking about market cycles. And the stock market is the leading indicator, which is usually a predictor of what's to come. Now, you may have heard of the term pricing in before, where in essence Wall Street have their fancy algorithms running in the background along with their knowledge and awareness of the broader macroeconomic environment, and as a result they price in the worst case scenario. It's why we saw the rapid market crash of March of 2020 before anyone even knew the true meaning of a pandemic and what that would actually mean for us and our lives. So from this you can see that the stock market reacts first and the economy reacts second. To give you guys an example, if you look at the recession between 1974 and 1975, you can see that the stock market actually starts to decline from 1973, 1 year before the recession had even started. But then the recession hits in 1974, but before 1975 the stock market starts to recover, despite the fact that the economy is still in a recession. So just because we're heading into a recession doesn't necessarily mean that the stock market is going to continue falling down in value. Because as I said, the stock market is a leading indicator, whereas the economy is a lagging indicator. And this analysis perfectly correlates to this market cycle, where you see peak stock market performance before you see peak economic performance. The sell-off then takes place because of the euphoria in the market and some worrying economic conditions, which then leads to the start of the recession, by which point the stock market has bottomed out and starts to recover, before we even see the worst of the recession playing out. So bear that in mind when you're analysing market cycles, because there's going to be a ton of volatility to come. It's almost like a game of chess where the stock market has already played its first move, and now we're simply just sitting back and waiting to see if the economy is playing in the same game. But truth be told, there's certainly no escaping the current situation which we're in, which is probably why it's worthwhile me reiterating this infamous quote of "buy when there's blood on the streets, even if the blood is your own." The next few months will certainly be testing for investors, but I suspect the best investment strategy for most of you guys out there will be the strategy that you already have. Because bear markets come and go, whereas bull markets, as we've seen over the past 100 years, are certainly here to stay. So as long as you can ride out the short term, you should be good for the next 3, 5 and 10 years thereafter. And that is, simply put, how you beat a market recession. So there's certainly my 2 cents. Be sure to let me know yours down in the comment section below. But before you go, if you do want to know a little bit more about where you can potentially get started investing, then be sure to click on this video here where I talk about 3 of the top funds that you could potentially look to buy and hold forever within your own investment portfolio. And with that said, I'll see you over in the next one.